The value and importance of mortgage rates is way overlooked by many buyers in the market, and I want to go over how a difference of just 1% on mortgage rates can affect the equity growth and monthly payments on your home regardless of the price point. For today's example, I want to keep it at a $500,000 purchase price with 20% down payment. Now, based on those figures, if you were to get a mortgage rate of 4%, you would be paying approximately $1,910 per month on the mortgage, principal, and interest. Now, the big contrasting factor here is if that mortgage rate went from 4 to 5%, a difference of 1%, you would be paying $2,147 per month on the same $500,000 purchase with the 20% down payment. So nothing has changed. You put in the same amount of money on the same exact property, but because the mortgage rate is 1% higher, you're paying almost $200 a month more for that same home. Now, this is going to get twice as interesting when we talk about the equity you generate over a 10-year cycle. Now, the biggest goal of buying property is to pay down your own mortgage rather than paying someone else's mortgage while renting a property. So if you're going to be buying a property with 4% interest rate over the course of 10 years, you're going to generate approximately $93,000 of equity. Now, in the same home, if you buy with 5% down payment, everything else the same, you're going to be generating over 10 years $81,000 of equity. So there's a huge gap there of about $12,000 of equity generation, as well as all the extra payments you need to make each month to get to that point. So you're paying more and generating less equity. So that's the importance right there on the 1% difference. Now let's scale it up to 6%, which is not an unfeasible number for a lot of people. You know, eventually mortgage rates can get to 6%. And when they do, how does that compare to the 4% we had originally? So to bring the numbers back, at a 4%, we're paying $1,910 per month and generating $93,000 of equity. But on a 6% interest rate on the same purchase price, we're going to be generating only $72,000 of equity while paying $23.98 per month. We're paying substantially more each month, generating less equity, obviously as interest rates are higher. But the biggest factor here that I really want to get people into is the mortgage rates today are hovering in the 4 to 4.5% range. They're in that zone. Catch them before they get to the 5s and 6s. Now, granted, if the property doesn't fit your needs and you're not finding the home that you want to live in long term, don't buy. Because you want to buy a home that is the long-term option, is the 5, maybe 10-year option. This way you can generate equity. The property has time to mature and appreciate with the market. What I really just want to emphasize here is that even though the mortgage rates are 4 1/8, 4.25%, stick it out until you find that long-term option that makes the most sense to you, because that's where you win. You saw in the numbers on the 10-year scale, the winning rate is in the long-term option hold. So the longer you hold the property, the more money you're going to make. It's exponential. It's clear math. Look it up. Ask me. I'll always give you the details. But if you can't find the right home, stick it out. If it's a quarter, maybe 1/8% higher on mortgage rates, but it took you a little bit longer to find the right home, it's okay because you're going to stay there longer, generate more equity. So always be in the market. Always look after that long-term option. Maybe you want to be a landlord as well. And that's how you're going to win in real estate. Reach out if you have some more questions. Be happy to help out. Thank you. See you next time.